All right, next one up here. JPM recommends selling Tesla. Here's a breakdown of the call.
Of orders and deliveries. Let's start first off with orders. The most for a month since the Paris or the Farnborough Air Show last summer. A total of 300 planes were ordered last month. That includes 150 as part of the big announcement with President Trump a couple of weeks ago in the Middle East. Those were to Qatar Airways. They also logged 146 orders for the 737 MAX. Speaking of the MAX, production last month has been increasing. Total deliveries for the month were 45, but more importantly, the deliveries of the MAX up to 32 for the month of May. And they actually hit a build rate of 38 at the very end of the month. Now, if they can sustain that, if they are comfortable with the supply chain, at some point they could ask the FAA. They've already indicated they're planning on doing this, perhaps sometime in the next month or two. Ask the FAA if they can increase production to 42 per month. As you take a look at shares of Boeing, keep in mind that the Paris Air Show is next week. So we'll get more orders and announcements. I'm not sure we're going to get huge ones like we saw out of Qatar, but you never know when you go into Paris.
So I get asked about Boeing, a decent amount, and kind of my perspective on it. Obviously, the stock's immensely lower than it was, probably 6-7 years ago. My perspective on Boeing is the same as it's been for years. Every time that company starts to get momentum and it looks like, they're actually pulling it around, here we go, they let you down. Every time, man, it never fails. Like, hopefully, maybe this time they don't screw it up and things go better for them and they just get it together there. But if you look at that company for the past 6-7 years, it's not like it's just been the last year. No. This has been a 6 to 7 year cycle with Boeing, where every time you can say things are going to look better, numbers are going to get better, it just gets worse. And something happens and it's like, oh my gosh. And so that's why Boeing just doesn't interest me. As a trade, I can see people maybe making money here and there in it, but it just seems like every time you start to get exciting, like things are turning around, boom, you get hit with something bad. It's crazy, man.
Meantime, Phil, we did get some reports this week that there were some fresh MAXs being, or at least landing in China. Is there a sense that those deliveries are getting more constructive with the trade backdrop?
Well, they did say that they expected for deliveries to resume. So to what extent, you know how this goes, Carl.
Is this Boeing?
They will deliver a few, and then, 3 or 4 weeks ago, the Chinese turned around and said, take them back. We're not taking delivery of these. That is 100% contingent upon what happens with trade negotiations between the United States and China.
Phil, appreciate that. Stay with us. We want to take a look at Tesla as well. Yesterday, it was Argus and Baird that cut to neutral over concerns about Musk's fraying relationship with the president. Today, it's JP Morgan. Their argument is to sell Tesla and buy auto parts suppliers. They argue that given the headwind from tariffs and some other regulatory changes, the impact will be much more benign for suppliers than for automakers. Wells does pile on a bit. They write that Tesla's on pace for another poor quarter on deliveries. Phil, despite the negative commentary, stock it's awfully hard to keep it down, certainly off of that 273 low the day of that feud.
They have a built-in core base of investors who are going to stick with Tesla regardless of what the delivery rate is, how much it slows down, especially in China and in Europe. When you look at all of this, Carl, at the end of the day, it comes down to Optimus and autonomous. And there are more than a few analysts who are saying, okay, cool. If that's the future, which Elon Musk told David Faber, it's Optimus and autonomous. How do you put a valuation on that? Are you going strictly on Elon Musk saying, exponential growth in autonomous or Optimus robots and autonomous, we're going to be all over the place? You can't build anything off of that. That is 100%. I think Elon is right, and I believe in Elon, and that's where the support is coming from.
Yeah, so in regards to Tesla, is the stock a sell? Sure, it's does it make sense to sell Tesla if you own Tesla? The answer is absolutely. But with that being said, you might not get the timing right because at the end of the day, the market's risk on right now. Look at the Russell. The Russell's up again today, right? You're in a complete risk on market. If the market's risk on, right, people want to take a risk. Tesla does very well in a risk-on market, right? So that makes it very difficult to get that stock down in the short term. As soon as the market starts to flip and you start to go risk off, which, when is that? I don't know. We'll see. Maybe it's a month from now. Maybe it's this fall, right? When you start to get some fireworks and maybe we get a 2018 situation, you get a big drop in the market. Once that happens, that's when we can talk about the deterioration of Tesla stock, right? But for now, if the market's risk on, it's insanely hard to get Tesla down in a risk on market. It's just the bottom line. Same thing with something like a Palantir or even an Nvidia. I mean, can you get stocks like Tesla and Palantir and Nvidia down in a risk on market? It's tough, really tough. Can you get those stocks down in a risk off market? Oh my gosh, off a cliff. I mean, we watched that with Palantir. Palantir went from $40 to like $6. I think it hit $5.98 in 2022. $5.98 from $40 at the peak back in 2021. We watched Tesla go down peak to trough about 70%, right? You watched Nvidia go down peak to trough 50%. So market goes risk off all of a sudden, Tesla will fall 50+%. It will get destroyed. But you have to get the risk off part right. If you don't get that part right, you have to kind of be very timely. Like I had some puts on Tesla recently, made like 40+% on those, cashed out and said peace. Because I was like, at the end of the day, the market wants to go risk on right now. And if now I still had those puts on, I would now be down big on those puts. Instead of making 40+%, I would have taken a loss if I didn't take my profit and get out and say, peace, I'm out. I'm good. 40% plus in like 2 days. Thank you. Bye. And so you have to kind of be, if you're hedging your portfolio and you get a chance to make 40+% in a quick amount of time, you got to take your money and run. Unless you go into a risk off market. Unless you're confident you're going to go into a risk off market, which you got to get a bunch of confirmations about that. And you need bigger things to be going on out there. You need like unemployment to be picking up substantially, or inflation, or the bond market popping, or, you need something that comes out of nowhere that's like big to really get a true risk off market where all of a sudden the S&P 500 goes down 10 to 25% in a short amount of time, right? Then we'll be talking about Tesla. If you talk about S&P 500 and NASDAQ goes down 10 to 25%, you'll be talking about a stock like Tesla goes down 30 to 50% in that sort of market. You talk about S&P 500 goes down more in that, 25 to 40% range, stock like Tesla will be down 50 to 80% in that sort of market. You talk about S&P 500 go down 50%, like what happened in the GFC, Tesla will go down 90%. 90%. But what are the probabilities you're going to get a great financial crisis type market, right? And remember, that market took a long time to play out. That market peaked, if I recall, summer 2007. The final lows weren't until, February, March of 2009. So it's not like it all just went in one day. So if you think there's going to eventually be a 50% type drop in the market where, in that market, Tesla falls 80, 90%, just understand it won't happen all overnight. It'll be a process that gets the stock there. Okay, so just all things to kind of factor in and keep in mind there, okay? Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. All right, Marko Kolanovic.
Since leaving JP Morgan last summer, he was the firm's chief market strategist, co-head of global market research. He joins us here on set. Marko, it is great to see you.
Thank you. Great to be here.
You're looking for a garden variety pullback. Does anything change based on what is unfolded this afternoon?
I mean, a little bit, because we got close to all-time highs. I believe NASDAQ was 1.5%. And then you had the sort of Tesla, you had Palantir, you had a bunch of these momentum stocks taking quite a bit of beating. So it does remind me on what happened February 19, if you remember. That was when the sort of Palantir went down and then momentum stock unraveled, So I do think that could be a catalyst for a bit of a correction, because close to all-time highs, but we still have all the problems. We have a trade war. We had a sort of signs of economic slowdown. Valuations are back to highs. So, that's sort of what I'm kind of expecting, a little bit of a pullback here.
Does that negative political backdrop, has it gotten worse based on what we've seen this afternoon between President Trump and Elon Musk, or is that a sideshow?
I think it's a little bit of a sideshow. It's important for a certain company, and it can spill over. Because if you look at the Tesla, is one of the biggest holding of retail investor. There were like kind of a little ecosystem of stocks around it. So I think it could be a little bit of a catalyst. Although I think much bigger problems are sort of what we saw, for instance, last 3 days with ADP, with initial claims, with challenging job cuts. I think that's like a real problem. And the fact that we have this trade war, which almost nothing is resolved yet, right?
Marco, a lot of folks want to focus on corporate earnings and really growth, right, as they think about the stock market and potential gains. But one thing that's really important, if you go back to, let's call it early April, when we didn't have a lot of clarity, we had a careening stock market and we had the U.S. dollar, well below, below 100. It got down to 98 or something. That's a U.S. dollar index. And we also had 10-year yields, which were much lower. Now they're much higher at 4.4%. How important is that disconnect, in your opinion, as you think about the macro situation here? Because you have a stock market that's very close back to its prior highs, but you have the 10-year yield and you have the dollar trading near where they were when the stock market was much lower.
So there is disconnect between dollar and 10-year, right? And 10-year, I think, is a problem, right? Because it sort of drives a lot of different things: real estate, commercial real estate, mortgages, all kind of things, right? Also, you need to compare equity risk premia and bond risk premia. What are you earning on equities? What are you getting from bonds? So bonds are cheaper than equities. Equities are expensive. So I do think that's a sort of a negative thing. There is a bit of also this standoff between Fed and the president, right? So everywhere else in the world, rates are being cut. Here, they are not. Eventually that has to impact negatively risky asset classes here. So bonds sold off. A lot of different theories, from systematic selling to sort of this divesting of our trade war sort of counterparts, to sort of, inflation, risk, term risk premium, all kind of different things, but that's a negative. It's a negative. I do think that bonds are probably oversold at this point. Last 2 or 3 days, we are seeing a bit of a rally. I think it's more driven by a weak economic data, or signs, hints of weak economic data. So I think we could have a bit of a convergence there. So equity is a little bit lower, bonds a little bit higher, just to kind of equalize a little bit these two yields of risk premium.
So a couple things. First of all, Treasury yields were closed 1 year ago. The 10-year closed at 4.39. It closed today at 4.39. So, on some level, there's been much to do about nothing. I'd be the first. We've all said there's reasons why we've been concerned about bond yields. And it doesn't sound like you're terribly concerned about a big sell-off. I'm trying to qualify, first of all, garden variety means also opportunity. I'm looking at a market now that also over the last few months has seen real allocation internationally. Any thoughts on that? That's the kind of work you guys did at JP Morgan. Yeah. Look where people are positioned. And again, this U.S. exceptionalism trade is something that got a little long in the tooth.
Yeah, look, I was on a Dan's podcast back in November, and I said, go buy international stocks. They're cheap relative to U.S., but that has reversed a lot. Look at the sort of DAX, that's been straight line up, to the kind of all-time highs. Situation there in Europe, there is a trade war. They do depend on exports a lot, right? So I'm not so, sold that now is the time to go in that trade. I think that's sort of past, with many of these international indices literally at all-time highs in the face of trade war, global slowdown, valuations that are reset higher. I'm not sure that's the time now. So I would probably stay away from that. If you were in that trade, great. I probably even didn't expect it's going to go this far, right? But Europe had some sort of, measures to stimulate, and so there's some optimism there.
So, the important thing to understand about Marco's call here is he's not calling for end of the world crash. Oh my gosh, we're going up 50%. He's talking about 5-10% correction at some point in time, right? Which, could it happen this summer? Maybe, but you might have to also wait for that for the fall, right? Which was like 2018. You had to wait till the fall time to get, and obviously that ended up being more than correction. But, the interesting thing about this Marco is he was highly respected around the great financial crisis time, coming out of that, and then very, very respected even in 2020. He was calling for, if I recall, the market to go to all-time highs. Even during the whole Rona craziness, and it did. But from my understanding, what happened over the last few years is this man remained very, very bearish. And obviously, we know the market's been great the last few years, right? 2023, banger year for the market, 2024. And so, from my understanding, it came to a head. And, once again, whether he was fired or whether he voluntarily left or was just kind of like forced out type thing, I don't know. But the moral of the story is he's out of a job right now, from my understanding, right? The JP Morgan chief market strategist named Gandalf, who left the bank last month after criticism he was too bearish, wants to know he was right all along, right? And yeah, he's out of a job right now. But the moral of the story is, a 5 to 10% correction. Like, I just feel like, there's a 5 to 10% correction every year. You know what I mean? Like that's nothing crazy. Like, I don't even remember last time I didn't see a 5 or 10% correction a year. Like, it seems like every year you get one of those just randomly, if not multiple of those in a given year. Like, so I don't want us to take too much from what he's saying there, and in those sorts of things. Now, I posted this because people were wondering about Tesla stock. And so, a few hours ago, I tweeted out this. By the way, if you don't follow me on X and you're interested in following me on X, I have it linked in the description area of this channel. So if you are interested in following me, go to the description area and you can follow me on there if you use X. But I said, if anyone's wondering what's going on with Tesla stock today, the market maker needs that baby to close around 300 for max pain, roughly a 5% up move, which is, look at that baby. They're doing exactly what they need to do. I guess there was a lot of people that yesterday with all the drama were buying puts left and right, and a lot of people were buying it around $300. They're either buying 300 puts or they're buying somewhere right around 300. And so, in order for a lot of those puts to expire worthless, the stock needs to close right around 300 here today. So anybody that sees a move up today in Tesla and thinks like, oh, the worst is over, those sorts of things, like this baby could continue to drop easily next week or the week after. This is just a kind of a mechanic move. This is planned move, I guess you can say. So do kind of keep that in mind. But man, good times overall. A lot of money to be made. Hope you guys are making a lot of money out there and all that good stuff. And like I said, this summer kind of represents a good time that if some stock valuations getting stretched, take a little profits off the table, redeploy that in better opportunities out there, hold some cash. You can still get 4% on that, and just be balanced overall. Don't get too bullish, don't get too bearish, all that good stuff.
Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in, or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com.
Dan Niles.
Got some of your thoughts in advance. It does sound like you think this 20% rally from the April lows can continue, yeah?
Yeah, I think in the short term, I don't have a super strong opinion, but I think it can continue. I think we could get to new all-time record highs. But remember, the reason I believe that is I believe demand is being pulled forward. If you're a rational consumer, you're buying things like smartphones, autos, PCs, because prices are going up. You've been told that as you get towards the holiday season. And if you're a corporation, just like Apple airlifted 600 tons of iPhones before the tariffs kicked in, you're doing that as well. And you saw that in the 41% growth in imports in Q1. And remember, the U.S.
So companies do that. I'm just not convinced the average consumer is going out there and doing that. I'm sorry. I'm not convinced that Joe, who makes, $50,000 a year, doing some construction work or something like that, is looking out there and saying, oh gosh, I got to go down to Costco or the Apple store or wherever and go buy blah, blah, blah right now because I heard prices might go up. I just don't think that's happening on a large level. Not to say it's not happening at all. I'm sure there's a few consumers out there that might make a purchase because they heard tariffs might happen. But I just do not think that's happened on a mass scale at all. People buy stuff when they really, really need it or really, really want it. That's just a bottom line. So, companies are sophisticated enough that they can try to get ahead of something, buy inventory. An average consumer, I'm sorry, it's just not. Come on.
It's 25% of global GDP. So that distorts numbers all around the globe. But if you're buying a car, smartphone, PC in advance, you're not going to be buying it during the holidays. So as we approach Thanksgiving, that's when I think you have to get very worried that much like you saw earnings come in better than most expected in Q1, I think you're going to see earnings come in worse than expected in Q4 because of that pull forward.
Right.
I just 100% disagree with him. Listen, if company earnings aren't hitting, I don't think it has anything to do, come that time, I don't think it has anything to do with a pull forward of demand. It could be other factors at that particular time that make a consumer not go out there and buy something if that's the situation that happens. But it won't be because everybody's going out right now to go buy iPhones or something like that. We're just not seeing any evidence that that's even occurring.
Up cars, because we did get a couple of strong months of what we think was a pull forward in demand on auto sales, but then we just got our worst month-on-month decline in 5 years. Isn't that payback already beginning?
That's the one thing and why I don't have a strong opinion right here, because I thought that would continue. And you are, to your point, Carl, you're starting to see some things get a little bit squishier. So it comes down to how much do people want to just sort of ignore that and say, hey, you know what? We got a great payroll number, though, right? And so the market's up off of that. Market seems to be trying to ignore 4.5% on the 10-year, 5% on the 30-year. And the fact that the dollar has dropped, people are like, well, ignore that because that's going to help corporate earnings, right, for companies that export. It's an interesting balancing act. And that's why, for me, with the market up 20% off of its lows after being negative entering the year, bullish, I think, on your program on April 7th, thinking there would be a short-term bounce, I'm now, again, sort of going, all right, time to raise more cash. But, I have like one short on in terms of stocks and just kind of play for a bounce to continue. But the further we get into the year, get a lot more cautious and expect another big downdraft.
So what he says there, I definitely can agree with that. In terms of if you're looking, let's say you're in a situation right now where you're light on cash, really light on cash, right? I can understand if you hold some stocks that have made some incredible runs. I can understand over the summer taking little profits here and there, right? But it really depends. It's a case-by-case basis. I talked about this on the main channel. I think it was a main channel. I talked about this a few days ago. It's a case-by-case basis. If you own a company and, the stock's gone up a lot, but it's still heavily undervalued, it doesn't make sense to take profits. But if you are in a stock where the forward P's gotten very stretched and you're looking at the stock now and you're like, man, it's risen 60%, blah, blah, whatever amount, right? But the valuation's starting to look really stretched. That is the moment. That is a moment where you can say, let me take a little bit of profits off the table, right? There's no shame in that game. But really take it on case by case. Because there's stocks I own personally right now. There's stocks that I own personally that I feel like, they're getting to very stretched valuations now at this point in time. There's other stocks I own that I'm like, they've just started their run. They got a lot further to go here. Not only for this year, but over the next several years, essentially. So break it down on a case-by-case basis, okay? Alrighty, next one up here, JP Morgan.
Some pointing out, David, the jobs number, the unrounded unemployment number has risen every month this year.
Well, that's right. This was a lot softer than the headline suggested. To me, that's one issue, is that we saw over 600,000 jobs lost, according to the household survey. That's very volatile, but that was a negative signal. The other thing is cutting 95,000 out of the prior 2 months. So we've only averaged 124,000 jobs so far this year per month, over the first 5 months of the year. It's 168,000 last year. And, I'm looking at a lot of data which shows this sort of slowdown that is gradually seeping up and spreading across the economy. And I think we're missing it because we're looking at headline payroll numbers or the weirdness in terms of trade and GDP. But this economy is gradually slowing down here.
Where do we think payrolls bottom out in the second half? Are you in the sort of 80 to 85 range?
Yeah, no, at the moment, I think that it'll be somewhere close to 100,000 jobs as an average going forward. But it could bounce negative,
right?
And in general, and even that is, I think the unemployment rate won't go up much because we're seeing some constraint in terms of immigration. But it's just a slower economy. This is a 1.5% economy. This is not a 3% economy.
So Trump's right. Fed should be cutting.
No, I think Jay Powell is right that he can't cut right now because you've got immigration, which is pushing up wages. The wages were strong this morning, and because you don't have enough labor supply, that's going to push up wages a bit. You've also got tariffs, and that has not fed through to inflation yet, but it will. We expect to see 3% year-over-year consumption deflation by July.
But the Fed can't do anything about tariffs or immigration. That's not the kind of inflation that they are used to fighting. And if you're saying there's moderation, and they're restrictive, doesn't it just make it worse?
Well, first of all, I think they're only a little restrictive, but two wrongs don't make a right. The Fed has got a responsibility to control inflation. And remember, we've also got this fiscal package, which is stimulative early on. You're going to have a big bounce in the budget deficit in 2026, which is pure sugar. Now, if that bill turns out to be, if it doesn't pass, or more likely, if it gets toned down a little bit, then maybe
this makes me sick. Stop it. Just stop it. Listen, man, the Fed is supposed to be data dependent. They say it every time. Oh, we're data dependent. We're data dependent. We're data dependent. Looking at the data. Dude, are we looking at the data or are we trying to predict what's going to happen 100 years from now? What are we doing here? Look at the data. The data shows you inflation's dead, lower rates. That's what the data shows you. If you want to have opinions on where inflation might or might not be 3 months from now, 6 months from now, 12 months from now, 18 months from now, that's not what the Fed is supposed to be doing. That's what they caution against. Like, if they were doing that, they would have been raising interest rates throughout 2021 and not having to wait till the second quarter of 2022 like they did, right? And so, like, the data is showing them right in the face, lower rates. That's what we're showing you. But if your opinion is, well, this and this and this, people drive too fast in the neighborhood, I'm just like, put in a speed bump. Come on, people.
Fed can think then. But they really need to see, is the rest of Washington, is the other side of Washington going to tone it down in terms of causing inflation for the Fed to actually feel comfortable there? So I think they're right to wait and see.
So what underlies your 1.5% GDP prediction?
Well, because so far this century, the economy has grown at a 2% rate. And that is
Lulu, Olabulu.
From 1.5% productivity growth and 0.5% employment growth. The problem is that right now we're seeing not just unauthorized immigration, but we're seeing legal immigration fall. In April, legal immigration fell by 16% in terms of authorized visas year over year. And if you take away that extra employment, and you don't have any employment growth because you don't have growth in the labor force, then you're back to 1.5% economy.
What about productivity increases as a result of AI?
We just had productivity disappoint.
Well, productivity will long-term increase because of AI, but even there you need to do capital spending and you need to do continual innovation. We need to be the leaders in AI. We need to continue to be the leaders in AI. And, I think there are, I'm in favor of deregulation in some areas to try to speed things along, but there are a lot of things that are causing businesses to hesitate to invest rather than to go full bore ahead in terms of investing right now.
Right.